Okay, let's get right into it. We are going back to the fall of 1987 to talk about the single worst day in the history of the stock market. A day when a powerful new technology, one that was designed to manage risk, ended up creating a global financial firestorm. On October 19th, 1987, the Dow Jones Industrial Average did, well, this. It dropped by 508 points, which was a loss of nearly a quarter of its value. In one day. And get this, to this day, that is still the largest one-day percentage loss in the index's entire history. It makes the famous crash of 1929 look small by comparison. And this wasn't just some Wall Street problem, no. This single-day crash vaporized an estimated $1.71 trillion in value from markets all around the globe. The shockwave was global, it was instantaneous, and frankly, it was terrifying. So that's the billion-dollar question, right? How on earth does that even happen? The sheer speed and the scale of the collapse, it was just unlike anything anyone had ever seen before. To really get it, you have to look at a perfect storm of factors. You had a super jittery market, some international tensions, and a brand new type of automated trading that, well, pretty much nobody truly understood. Before we dive into the chaos of the day itself, we really need to get a feel for the atmosphere. The mid-'80s had been one heck of a party on Wall Street. A massive 5-year bull market had pushed stocks up to heights that a lot of people thought were just unsustainable. There was a feeling in the air that a correction was coming. But no one, and I mean absolutely no one, expected what happened next. Things just unraveled with breathtaking speed. The week before the crash was already brutal. The U.S. market had a couple of sharp drops. Then, get this, a literal freak hurricane forces the London market to close on Friday. Now, that might sound like a weird little detail, but it was absolutely critical. It created this huge backlog of sell orders, like a coiled spring of selling pressure just waiting to be unleashed on Monday morning. And boy, did it unleash. The panic started in Asia and just spread across the globe like a virus. Hong Kong's market was absolutely devastated, falling almost 46%. Australia, the UK, this wasn't an American problem. This was the first truly global crash of the modern, electronically connected era.
So here's the crucial point. This crash was unique. Its incredible speed was fueled by a new and frankly poorly understood technology. It was a strategy that was actually meant to protect investors, but instead it created this devastating feedback loop that sent the entire market into an absolute freefall.
The main villain in this whole story was something called portfolio insurance. Now, it's super important to note this was not a real insurance policy you could just go out and buy. It was a computer-driven strategy. The idea on the surface was pretty simple. If the market starts to fall, our computer programs will automatically sell stock index futures to hedge our big stock portfolios from losing any more money. Sounds smart, right? Well, here's where it turned into a death spiral. Just follow the steps. 1. The market drops a little. 2. The portfolio insurance computers see this, and they're triggered to automatically sell huge amounts of futures. 3. This flood of selling makes futures prices plummet. 4. Now, other traders, they're called arbitrageurs, see that futures are way cheaper than actual stocks, so they buy the cheap futures and sell the real stocks to lock in an easy profit. But all that selling of real stocks does what? Well, step 5, it pushes the entire market down even further, which, you guessed it, triggers the portfolio insurance programs to sell all over again. It was a vicious cycle, a machine feeding on itself, and it was completely disconnected from the actual value of real companies.
So the crash happened, and the world just held its breath. Everyone was terrified of a repeat of 1929, of another Great Depression. The entire financial system was right on the verge of collapse. But what happened next? Well, that was the critical response that changed everything.
And this is the great paradox of Black Monday. This single-day drop, percentage-wise, was way, way worse than the infamous crash of 1929. So why didn't it kick off a decade of economic misery? The answer lies in the swift, decisive action of the central bank. The day after the crash, the new chairman of the Federal Reserve, Alan Greenspan, put out this short, deliberately calm, but incredibly powerful statement. It sounds all formal, but it was a clear promise. He was saying, "We will do whatever it takes. We will provide the cash, the liquidity to make sure banks don't fail." That one sentence calmed the panic and stopped the financial crisis from bleeding out into the real economy. The Fed's actions worked, but the shock of the crash was a massive wake-up call. It forced regulators to build new guardrails for a financial system that was suddenly faster, more automated, and more interconnected than anyone had ever imagined. The legacy of Black Monday is actually all around us today, in the market's modern plumbing. It's the reason we have circuit breakers. Those are the automatic trading halts designed to just stop a panic and give humans time to breathe. It also created this idea of the green span put, this belief that the Federal Reserve would always step in to prevent a total meltdown, basically putting a safety net under the market. And that set a powerful precedent for every financial crisis that came after.
And this brings us to a really crucial distinction. This crash was about broken market mechanics. It was not about failing businesses. I mean, look at these companies, Microsoft, Coca-Cola, Johnson & Johnson. Their stocks got hammered just like everybody else's, but their actual businesses were perfectly fine. People still needed software, they still drank soda, they still bought toothpaste. This proved that a huge systemic crisis could be completely disconnected from the real economy, a lesson that would become incredibly important in the decades that followed.
Which, leaves us with a final thought. The technology has evolved so dramatically since then. The portfolio insurance programs of the 80s look almost quaint compared to today's world of AI-driven strategies and high-frequency trading that operates in microseconds. The tools have changed, but that fundamental risk, the risk of an automated self-reinforcing cascade, is still there. So the question is, what's the unseen flaw in today's system that we might only discover when it's already too late?